Good morning, everybody. Hope everybody's doing well today. Let's get to Tom Gentile in 5, 4, 3, 2.
Hey everybody, Tom Gentile. Welcome to another session of the Opening Bell. Glad to have you here. Hey, if you're coming into me from Monday Morning Live, good morning, everybody. Let me know what's going on, where you're from, and that lets me know this chat box is actually working. So excited once again to be joining you. And I got a great show for you today. We're actually going to talk volume today. So I've got, I want to talk volume. I want to revisit what I discussed last week. I want to show you how that HPQ trade worked out for me. Of course, much more. Looking at everybody coming in. Yeah, go Bucks. I had my hat and I thought, you know what? It was putting a pretty big rim on the side of my head there. So I went ahead and pulled that off here right before we went live. Also, for those of you that are joining me on the YouTube channel, I want to welcome you this morning to our YouTube live stream. All of these are being put together, simulcast together. So good morning, everybody. I actually see the chat coming in on both sides. I will be going to that here throughout the hour. So anyway, what's going on, guys? What is in the news? Let me look and see here. I'm pulling it up right now. You know, I pull this off the driveway every day. And, you know, Ryan, do you get the Wall Street Journal at all?
I do not.
Yeah, well, don't worry. You're not missing anything, because what's really happened more and more is this really is old news. It's used to be where we'd go to kind of get ideas. And I'm talking about back in the 90s, you know, back in the 80s, the late 80s. This used to be the place to go to get the news. And now when I see it, it's really, I call it fading news. You know, by the time you read it in the Wall Street Journal, in most cases, the best thing you could do is just simply fade this stuff that we see. So anyway, that's down on the floor for now. That'll go in the cat litter box or bird cage or wherever it ends up going before it hits the trash. So a lot of we want to talk about today. So I want to do an outlook on the markets. We had an interesting day yesterday. Where we had a day where the S&P opened higher and closed lower, and it became something called an outside day. I don't know if you guys saw that or not. Is it going to mean something? Are we looking for potentially more pullbacks? We will see. We're going to analyze that this morning. You know, when I saw the markets coming into this morning, looked kind of mixed. Did not look like we were, you know, having one of those days where it was going to be an outright down day. All right. But when you looked at the indices, looked at the S&P, the Dow, the NASDAQ, everything looked a little bit to the downside. We'll check in on that and see where that's going as well. What else have I got to look at? Unusual stock options for today. So we're going to pop in and look at unusual stock options. If we have some crypto news, we'll bring that up too. Big thing I'm seeing. In fact, you know what? There is some crypto news. If I have time, I want to share it with everybody here in the live session. I got a buying opportunity, a second buying opportunity on something that we all discussed a couple weeks ago in the room. Although it's the same crypto but a new signal. So I want to show you that. And of course, I really want to get to selling. All right, selling volatility. That's really going to be the key for what we're talking about today. Because, you know, for me, what I want to do with you here during this opening bell, during this 9:30 to 10:30 session is I want to talk about and educate you on things that work in the marketplace. So I want to show you something that's been working and not only working just, you know, recently, but has been working long term. But I am going to show you the November numbers, you know, for what we've been doing in the area of volume. Good and bad, winners and losers for everything that we've done and closed up in November so far. So I got a lot to share with you here in the hour. Glad to have you guys here. Welcome aboard. Let's get going. And let's go ahead and start off, first of all, with an outlook. So I want to do an outlook on the stock market. I want to look at the bonds, but I'm going to do it a little differently. All right. We're going to look at a shorter term outlook. And for that, I'm going to move over to my Thinkorswim platform. And I'm going to start by typing in SPY. And as you can see here, and what I did was I have a simple chart on with volume. And so, you know, this goes all the way back to last year. This is a year to date chart you see here. And the part that I'm most interested is what's been happening in the area of November. So let's bring up November. Here's November. Let's blow that out so you can all see it. So November started out with the SPY around 460. Yesterday, really sometime after the open, we hit a new all-time high. And then a very strange thing happened, okay? The news basically sold off on Powell being, kind of getting his seat for another term as the Fed chair. And we saw the markets go from 473.54 down into the 460s. Well, today we were positive for a very, very small amount of time, maybe a couple seconds, because we're only 7 minutes into the day, and SPY has already dropped and started to move down into the 460, mid 460s. Where we go from here, obviously, we'll see what that happens. But we did this before. Go back and look at what happened at the beginning of the month. We gapped up, all right? We had a move where we ended lower. Now, what ended up happening was it took a couple of days, but we did see a pullback. But if we take a look at that high to low pullback, that took us from just above 470 down to around 462. There was about an 8 to 9 point pullback in SPY. Now, let's fast forward. 473.54, right? A 9 point pullback from that high would take us down to around 465.50, 464.50. 464.50 is going to be right down here, folks. So we'll be monitoring that, okay? That might look like a good support point, just looking at the last move that took us to all-time highs and then the subsequent pullback in the market. Very interesting stuff that's happening here. Let's take a look at bonds. So when I look at the bond market, I'm looking at TLT. TLT is, in my view, the overall view of the bond market. This is an ETF that we can all track in the room. This ETF looks at 10-year or 20-year bond prices. And again, this is something you look at in your equity account. So what has it been doing? Well, since November, if you take a look at where we were November 1st. November 1st, bonds were closed at about 146.45. Look what we've done since then. We've gone to the 150s. We've dropped down into the low 140s. And where are we right now? 146.03. So the bond market made a move higher, made a move lower, pretty much sitting where it was at the beginning of the month. Let's take a look at cash. For cash, I like to look at the symbol UUP. UUP is the cash market, the U.S. dollar cash, or what we like to call the double dollar index. Double dollar index looks at the U.S. cash market versus a basket of stocks. It's called double dollar because it moves at twice the speed of the U.S. dollar. Now, when you look at this and you see that on 11/1, this was trading in the low 25s, and here we are today trading in the high 25s, you might say, we've moved less than $1 in U.S. cash. And this is the double dollar, which means cash has only moved up maybe about 50 cents, when you're looking at a move here. Now, I want to mention this to everyone. Cash, the U.S. dollar should be the most stable currency in the world, and it should be one of the most stable asset classes across the board, right? So it's no surprise to me that it made a small move. But this is the interesting part. We're now trading up in the high 25s. When's the last time we were trading in the high 25s? Well, let's go back and look at this chart, right? I'm taking this chart all the way back to the end of last year. We have never traded this high in 2021. In fact, the highest we got in 2021 prior to this move up here in the last quarter, you had to go all the way back to the first quarter of the year when we were trading at 25.15. Right? So this U.S. dollar going up. Again, it's going up against foreign currencies, but it's also telling us that we could be in for potentially some more moves to the downside with the SPY, U.S. dollar, etc. So when I look at this, I have to take a look at this, and I have to look at it with different lenses. Lens one is, U.S. dollar is going up. That means that other currencies, commodities, and assets might be easing back. But number two, UUP is not a real way of looking at the U.S. dollar versus commodities. It's a way of looking at U.S. dollar versus the rest of the world. Right? USO. Now, there was some news that came out. I saw it on the wire earlier today that OPEC, let's see here what I got here. U.S. announces coordinated oil release that may draw ire from OPEC. Basically, what it means is that we're looking at when I see coordinated oil release, is that coming from the reserves? Is that are we starting to drill again? Again, the devil is in the details. But when you look at USO, it doesn't seem that that's the case, because USO, look at what's been going on since October or since November. Beginning of November, USO was trading up here in the high 50s. In fact, it opened near 58. Dropped down as low as 53 last week. We're at 56.02, but there's a gap in USO, gap higher, which means that the news that I see, U.S. announces coordinated oil release, doesn't change the fact that oil prices are remaining high. I would have looked at that news and said to myself, if we're going to release more oil out into to the consumer, isn't that going to put ease pressure on supply? Isn't that going to make the price of oil go lower? But then again, and I got to drop down here to say it, when it shows up on here, when it shows up in the news, potentially doesn't mean that it's going to go the way you and I think it's going to go, okay? One thing I've learned in trading in over half my life doing this is that every time I think something's going to go in a certain direction, emotionally, I'm typically wrong, okay? That's why I'm a rules-based trader. That's why I don't think my way to profits. Do I make money every time? No, absolutely not, okay? I make money over time, and that's what I want all of you watching this program. I want you to keep that as a takeaway. You win some, you lose some, but you make money over time. All right. So that's stocks, bonds, currencies, commodities. Let's take a look at BTC, and I'm actually going to look at the futures markets today, and that is /BTC when you're looking at it right here on the Thinkorswim platform. All right. So I'm looking at this, and hey, is something wrong here? All right. Is BTC having an up day today? It is a small update, but an update nonetheless. So if we go back and take a look at what's happened with Bitcoin futures here since the beginning of the month. Here's November 1st, trading at 60, right? Here is November 10th, the high. Now again, futures market, not the cash. Futures market, the high was 69,355. That was the tippy top high. That actually happened about 2 weeks ago. Here we are today, 56,008. We did make a new low for a small amount of time before now starting to come out of that. We'll see where that goes. But in any case, what I'm seeing here in the last 3 days is an area where we could be building support. Building support where? 55.5, okay, 55,500. That is on the futures markets, all right? You got to take about $500 off of that price to get somewhere near cash. So what's the difference between the futures markets and the cash markets? Well, it's simply this. Futures markets, this is a leverage basket to buy 5 Bitcoin, 5 BTC, right? And that leverage basket means that you're going to get somewhere less than the price for cash. So think about this for a moment. If I were going to buy 5 Bitcoin and I were going to pay $55,000 a coin, what's that going to cost me? $525,000, right? So 5 times 5 is 25. That's 250,000 Bitcoin. Add another 25 on. You're talking about $525,000 to buy 5 Bitcoin at $55,000. What this instrument does is it allows you to leverage in, and in a sense, you're able to buy 5 Bitcoin, but only pay about 50 to 60% of that price. That's leverage. Now, typically in the futures markets, you'll see leverage of 5 to 1, 10 to 1, 20 to 1. But because Bitcoin is the fastest mover in any asset class that we've seen, the fine folks over at the Chicago Mercantile Exchange do not want you to over leverage, because if you over leverage and buy too much of this and it goes against you and you can't pay that for that leverage, guess who's on the hook? All right. Who's on the hook is the exchange. The exchange that trades this is on the hook to cover you if you run out of money. So they want to make sure that doesn't happen. That's why the leverages in this instrument are actually quite low. It's the lowest that I've ever seen. But the other reason I talk about the difference between futures and cash is because the futures markets build in time premium. You might say, wait, pump the brakes here, Tom. Time premium, isn't that just in options? It isn't any instrument that has future value. And this has future value. BTC, the futures contract, is a leveraged contract that goes on between now and last trading day. Last trading day for futures markets are typically in the last week of every month. So we're looking at the November contracts right now, and November contracts end next week. All right, so now we see that we know a little bit about futures contracts. I don't talk about trading these. I only talk about looking at this on a platform like Thinkorswim. Just gives you a different perspective for looking at what's going on with Bitcoin. If we wanted to see Ethereum, by the way, for Thinkorswim, the symbol for this is /BTC. If you're a Thinkorswim user and you want to see what Ethereum futures are doing, then the symbol is /ETH. Let's put that up on the screen. You can see here, Ethereum has a quite a different look to it as we moved higher. And yes, we hit those all-time highs at 49.02. And yes, we've backed off to just below 4,000. And now we're starting to build some support here at around 4,000, right? 42.32 today for the futures markets. Again, you got to back off a few dollars there. You got to back off with this one. You got to back off somewhere around $40 to $50, and you'll see what the actual cash is trading for. So there you go. Maybe we might have created some support here. I'm looking at catalysts in this market to see where Bitcoin, where Ethereum, where a lot of the cryptocurrencies that we follow are going. And one of the big ones we talked about yesterday, the two most recent are Powell's, second his additional term as Fed chair. The other one that I thought was interesting was Crypto.com Center, now formerly known as the Staples Center, Crypto.com Center, which will just continue to increase the brand of not really Crypto.com. I think it does increase Crypto.com's brand, but I think it really increases the brand across the board for cryptocurrency as a whole, especially Bitcoin and Ethereum. Okay, what do you guys think? Let me know in the chat box. I'm kind of cruising around looking at these things here from point to point. Good morning from the West Coast. West Coast, wow. I mean, you know what? I always wanted to live on the West Coast. When I was in my 20s, I thought, wow, what a great to live out there in an area in California, and to be able to wake up and trade the markets from 6:30 to 1 o'clock, then grab my surfboard and then hit the beach at 1:30. That was my idea growing up. I thought, wow, I could, this could be a part-time job. It already is a part-time job, but it could force me to get up at 5, do some market information, look at some strategies, look at some systems, do some trading. And even if I sat in front of the computer all day long, markets close at 1, and I could hit the beach. What happened with that dream? Well, taxes in California, they were just as bad back in the 80s, in the 90s as they are now. They just look worse today. But back then, when everything was relative, kind of looked the same. And I was looking at that and I was thinking, all right, so that, and plus I didn't learn to surf. That was another big thing too. It's hard to learn to surf when you live off the coast of Georgia. Have you seen the waves down at St. Simon's Island? There aren't any. Unless there's a hurricane coming up the coast, you're not going to be able to catch any good breaks. So that was it. Ryan's like, I'm gonna cut this stream short. We're going to the beach. I live just a few minutes from Siesta Key. There's not much of a break there either. When you live on the Gulf Coast, it's like this big hot tub. It's what we like to call it during the summertime. Not much break there either. So Anyway, just saying. All right, so let's go ahead and we've talked about the overall markets. And what I want to do with you now is I want to share with you a strategy that I discussed last week. Does any of you remember? Do any of you here remember? Now, those of you on the YouTube channel, we weren't here last week. So I want to give you, and I want to give any of you in here that are new. All right, not talking about money calendar today. Not talking about, high probability. Well, we are going to get into high historical probability strategies, but I'm not talking about selling puts today. Okay. I'm not even going to get into crypto so much other than the news we're talking about today. What I want to talk about with everybody today is I want to talk about volume. Okay. Tuesdays are my volume strategies, and that's what I want to do with you guys. So, I don't want you to keep coming back here every day and we just do the same thing over and over. Rinse, repeat, rinse, repeat. If you jumped in the shower and you followed the instructions on the back of the bottle of Suave, which says lather, rinse, repeat, you'd never get out of the shower. You know what else would happen? You're going to get soap everywhere. You're going to run out of soap. Educationally, what I want to do is I want to take you into different areas and show you a basket of different strategies and give you the education on those strategies. And then tell you where you can get more information if you want to follow me in those strategies. So let's talk about Roll Tide. We talked about Roll Tide. Crypto Bunny was with us last week. And Roll Tide meant last week we were talking about that 1 to 2 weeks prior to kind of snipe in there. Get in there when no one's looking. Get in there when mainstream media is not talking about that particular stock, but we're looking at it and going in and buying call options or buying put options based on past price and volatility action. Okay. So those are what we do. We call those pre-earning strikes, all right, or surge strikes. Now, another surge strike is to go in right after an earnings report, where we all know what happens before an earnings report. Typically, the stock market starts to tighten up. And then it's like a spring. If you tighten up a spring, you let go of the spring, eventually the spring's going to bounce out and it's going to go somewhere. Might hit you in the eye, might not. Might hit the other guy in the eye. But a rollout is when an event happens and then we see the reaction to that event. Okay? It's happening in Zoom today, Zoom Technologies, ZM. We'll take a look at that one, but let's rewind a bit. Let's talk about this roll-in. So the roll-in is we're looking for patterns that happen over and over again. Again, guys, I'm a pattern trader. Everything you're going to hear from me, it doesn't matter what day it is. Everything you hear from me is going to be based on some sort of pattern. Some sort of pattern that we have spotted that's happened over and over and over again, and we're going to look to profit from the repeat of that pattern. This is what we looked at last week. So I showed you a trade I was doing in Hewlett Packard, right? And I told you last week, I'm going to follow up on this. I'm going to let you know how it came out. This is last week's chart. If you remember, we were looking at a pattern in Hewlett Packard where I looked at this and found the week prior to earnings, week and a half prior to earnings, Hewlett Packard had gone up in price every quarter for the last 4 quarters. Now, how many quarters do you go back before you finally just, you give up? Well, I go back, and if I can see the last 3 quarters in a row that the price is doing something and or the volatility is doing something, then it's going to catch my attention. And that's exactly what happened with Hewlett Packard. It had been going up in price that week to 10 days prior to the earnings report. The other thing that was going up in price was this, the volatility. Now, in this case, we see the red line, and I'm charting the red line. I'm seeing price. Notice here, I'm going to follow the red mouse, the big red mouse, all right? Week prior to earnings, price going up. Week prior to earnings, price going up. Week prior to earnings, price went up a little bit. Week prior to earnings, price went up. And here we were last week. Now, I want to show you something else. See the red line? This is options. These are option traders. As this goes up, that means they're pumping up the option premium. because all of a sudden everybody's starting to climb into the trade. Week prior to earnings, this is back at the end of last year, we saw a spike up in option premium. How much was that spike? Well, we went from about 48 to around 54. Okay, that's 6 points in volatility. 6 points on something that's 48. That's a 15% increase. Look over here, week prior, 20% increase. Week prior, 20% increase. Week prior, 20% increase. And look what's starting to happen last week as I was jumping into the call options on this trade. Why did I take calls? Why didn't I do puts? Why did I just take calls? I love you too, Patty. Why did I take calls? Because two things were happening. Price rising, vol rising. If price is rising and vol's rising, I want to do the calls. Is it possible that the price could always drop into earnings and the vol go up? Yes. And in that case, I would take put options. But this was the case. This was the trade that was handed to me last week by my computer. Brutus. Do you guys all know Brutus? Let me introduce you to Brutus. Brutus is the artificial intelligence that I use to help me spot these opportunities. So Brutus comes out here and says, hey, you need to take a look at Compaq. You look at or Hewlett Packard, HPQ. You need to take a look at Hewlett Packard Compaq because it's been going up in price the last 4 quarters and the vol's been going up too. So I looked at the call options. All right. Now I'm going to walk you through exactly what happened. So for that, we're going to pop on over to my tools and I'm going to go bring up some option chains and I'm going to bring some option chains up on HPQ. Go back to last Monday. So I'm going to take us back in the Wayback Machine to November 15th. All right. It was a cold and stormy night on November 15th. I don't know what it was. It was during the daytimes when I took this trade. I can tell you that. I was looking at options that expired on the 26th. That's this Friday's options last week. Why? Because the event I was looking at was happening this week. Okay. In fact, it's actually happening after the close today. But let's go ahead and take a look at this. And I'm going to go 10% up and down. So last week, when Hewlett Packard was trading at around $31.35, those November 26, 32 calls were trading for 71 cents. Okay, so if I decided to buy 10 of these, let's go ahead and click on a risk graph. Let's see how much they cost. So to buy 10 would cost me $710 or $71 a contract. This was very, very cheap. Okay. So in this case, I'm going in and, I'm looking at this. Again, spotting the opportunity was the pattern that was happening every week or so before earnings. Creating the trade we're doing right now. So I'm going in and creating a trade. I'm looking at the trade and I'm saying, all right, what's my break even? What's my worst position loss would be $710 if I held this all the way to the expiration date. Here's Hewlett Packard. Look what it's been doing. It's kind of been going sideways, but it looks like it's building up some pressure to continue to move higher into the week of earnings. Remember, this was last week, guys. Those of you that were with me, you saw me walking through this and showing you what I did. Now I want to take you through what happened. All right, so I'm looking at this. I know how much it's going to cost me. I think I did a few more than 10 contracts, but that's a different story. So here you go. Take a look at what's going on here, and we see, all right, I spotted the opportunity. I've created that alternative trade. Now I plan, execute, and manage. Planning it means putting it into my broker. Executing it means hit that button, get filled. Managing it means this. I'm looking at this trade and I'm saying, all right, now I get filled. By the way, I ended up getting filled on this for 75 cents. So I'm thinking if I can get a double out of this trade, then I'm going to pull the trade off. So in order for my 75 cents to double, what do I need this to do? I need this to go to $1.50, 70 to $1.50. All right, so let's see what ended up happening. So I'm going to up here, I have the ability to up here to go in and Move forward in time. So here we go. Let's plus a day. Now we're at 11:16. What's going on with the trade? I'm down a little. I'm down $5. You see that? I'm down $5 per contract, or I'm down about $50 on the trade. That was a day later. Again, things don't always work the way we see. When I look at a pattern and I see it going up, the last 3 or 4 quarters, does that mean it goes up every day heading into when I'm supposed to exit? No, nothing always happens the way we want it to. Let's plus a day. Here we go. Okay, now I'm down $180 on the trade. If I'm long 10 contracts, I'm down 25%. What's going on? What's happening with this thing? Let's go look and see. Oh, look what's going on with Hewlett Packard. It's not going in a direction that it has gone in. Or wait a second. I have an entire week for this strategy to work. Okay, but let's look at volatility. Is volatility going in my direction? Oh, yeah. Look at that red line. Red line's going up, so they are increasing the premiums. But what's going on with the stock? Wow, the stock's gone down. The stock's $31. A couple days ago, the stock was $32. It's dropped an entire point in the area of 2 days. But you know what? My option trade has only dropped $18 per contract in 2 days. So the volatility, the option traders are feeding me. I'm losing money on the trade because it's going against me, but the option traders are back feeding me because more and more people are getting into these call options. All right, now let's move ahead a day. Now we're at the 18th. Okay, look what happened. Now we've jumped. Something's happened. I'm now profitable by $7 per contract. Let's go down and take a look. Look what happened. So Hewlett Packard actually came down a little bit, made a new low, but then it rallied. Then there was this push, the push to buy the stock. What's going on with volatility? Still going up. Look at that. Actually made a new high for the month. Because you know why? Because we're getting closer and closer to earnings. Let's push it forward another day. All right. Where are we at now? 11:19. All right. 11:19, it's only up $3. Let's push it forward another day. I mean, I could just go on and on and on, but take a look at this, guys. All right. This was yesterday. Your $71 per contract investment has a profit of $50. You know why? Because the options that you paid, let's say I paid $75 for, they went 117 by 124. Okay. This was on 11/22. Yesterday was 11/22. Let's just plus a day. And you know what? Here we are. It's 11/23. There you go. Your $71 hit $67 of profit, 94.4%. Let me just look at that chart. You see that chart? I want to show you a couple things. See yesterday? See today? Do you think if you closed yesterday or even today at 95%, but yesterday that tip moved even higher? Do you think those options traded yesterday for $1.50? Well, there's only one way to find out. Let's take a look. Okay, let's take a look. So I want to come on over and I'm going to go to this chart. Now, in order to look at options on any stock option where you're using Thinkorswim, you've got to start with a period. Period HPQ. That's the symbol. All right. The year is 21. The month is November 11th, and the day is 26. That's the options expiration date. Now we're going to put in C for call and 31. Once you've done that and you hit enter, you're going to see what these went for. Wow. Look at that. Look at it move. That was all off of something that I talked about last week that was trading very, very low. All right. Pretty cool, huh? Pretty cool that I showed the entire community how to do this, how to go in easy peasy, quiet. Nobody was talking about Hewlett Packard. I keep calling it Compaq. It's the 56 in me. But no one was talking about this last week except me. Moi was talking about it last week. But moi didn't offer it up as a recommendation. Moi showed you the reason why I didn't was because I was already in the trade. I put the trade on, all right, before I talked about it. And I share examples with you guys. I'm going to give you a trade today we could do. It's going to be on a different way of looking at this. But again, I'm not going to take a trade on something and then tell you to do it. All right? That's front running. Me no do that. No, me no do that. All right? So today I'm going to share with you a way of looking at this a little differently. All right. And if it means it eats into my unusual call options and put option part of today, then we'll pick that up tomorrow. Because I want to make sure you understand this. I want to give you a trade today. I want to show you 5 different stocks that might have a that again might have some common denominators here. And you know what the best part about this is, Bomber? You don't need a VWAP code. You don't need a VWAP code to do this. Okay, so let's talk about how we do this. I talked about this last week. Now, let's talk about rolling, the different way of rolling the tide. Okay, so I want to talk about rolling the tide. By the way, this is the examples I showed you last week because I was getting these last week and I was seeing these calendar days before exit, and I was looking at Compaq and I was looking at the exit date. Okay, this means that I want to exit it before the earnings. The earnings are coming up after the market closed today. But look at these other ones that popped up. Brutus was saying, "Hey, you could take this on the 19th. You could take this on the 17th. You could take it on the 19th." There's a couple different earning entries here. Over here, we're showing the last 4 years average return on profit: 86, 75, 68, 60. So I'm in and I'm out. By the way, how do you get out of something if you place it? And this is a question for everybody. All right. How do you get out of something? How do you set yourself up to get out of something ahead of time so that when, say you're like me and you're doing your job, and my job, guys, my job is setting up and getting ready to educate you. I have the toughest hour of the day because it happens when the market opens. So how am I going to get out of something if the market's open and I'm not looking at it because I'm busy doing something else? Matthew said it. Sell the call with a limit trade. Put in a sell to close. LSU Tigers. Well, 2 out of 3 of those answers were correct. All right. How's my YouTubers doing over there? I mean, again, selling limit orders, guys. Putting those in ahead of time and doing what's called, let me add to that, GTC, good till canceled. I put my limit order in days ago. So that's the purpose of what I wanted to talk about with you on what we did last week. Let's fast forward to this week. So this week, I want to get into the other side of volatility, and that is what to do after. What to do after the earnings come out. Okay, because after the earnings come out, we get a lot of movement in the stock. Okay, let's take a look at well, first of all, I want to show you 5 of these stocks. What do these 5 stocks have in common? Okay, I got Tesla, BT, FTCH, Roblox, and Roku. What they all have in common is they've all, in the last 30 days or so, have had a significant volume event happen. They've all had something significant in volume. Let's take a look at those. Tesla, TSLA. All right, so look what happened here. Here was Tesla. And here's the news that came out, but then look what happened. We had a spike in volume. Now, Tesla's spike in volume actually came 2 days after earnings. But then look what happened after that big move. We continued to thrust momentum, and this thing just tore it to the upside. All right? What about BT? All right? BT. Okay. Now take a look at BT. What happened with it? Okay, look here. Again, see the volume surges? By the way, let's bring this up so you can really see it. See these volume surges? Boom, boom. And then we stay above and actually move higher off the surge. Okay, how about ROKU? Right, I could show them all to you, but this is basically the fact of the matter is this. Here's a gap down in Roku. Here's a jump up in volume. So a lot of surge happened on that day. And then look what happened after that. We just kind of dribbled down. Do you know that it's around 70% of the time what we looked at on the stock list that we look at. When a surge happens, the stock typically tends to move in its future direction. All right. And what I mean by that is that you get the surge. It's not what happens the day the surge happens. It's what happens afterwards. Look at what happened. We took the low out here in Roku, and then we just started going lower, and then drop down again. New surge, and now continuing to go lower. All right. The surge is telling us that the stock wants to go down. You play it to the downside. Is it going to work 100% of the time? No. But more often than not, it does work. Okay. Now let's look at Zoom today, ZM. ZM is a setup day, folks. Zoom is amazing. I mean, this stock was just absolutely murdered, and it's continuing to get murdered again today. You got a gap right here. All right. So what's happening is the surge is setting up right now. Today is not the day to trade Zoom. Today's not the day to buy Zoom. Today's not the day to sell Zoom. Today's the day to wait and watch Zoom. And the reason why today's the day to watch Zoom is because when you look at Zoom, it's what happens tomorrow that's going to make me decide to pull the trigger on Zoom. You say, well, if that's the case, Tom, what can I look at? What can we look at today? All right. So I was looking at Kraft Heinz, KHC. Look at KHC. What have we learned about KHC? Well, it had a down day. It had a big jump in volatility. But you know what? Here's the low. Here's the high. All right. We did not go below the low, but yesterday we ticked above the high. So you know what this is? This is a bullish opportunity. We've spotted a bullish opportunity in Kraft Heinz. What do we do after we spot opportunity? We look at trading the low or the alternative risk trade. What's the alternative risk trade? I've yet to put it together, folks, but I'm going to do it for everybody here right now. KHC. Let's pop on over. Let's take a look at the stock and option table. And what I want to do is I want to move to today's date, because today's date's the part that's worth looking at here. Let's go ahead and type in KHC, Kraft Heinz. So Kraft Heinz, and I don't have to go that far. I can just look at the options that are 10% within the price of the stock. Now with KHC, if you come on over and you look at, again, which options do we want to use? Okay, well, let's go take a look at a chart on KHC. And the reason I want to look at a stock chart, an end-of-day stock chart on KHC, is because I got all this information right here. KHC for you. Earnings. Well, we know the earnings have already come out. See that? Earnings have come out, but we got a drop down, and this created a surge strike. And we also got to move higher off the surge. So now I'm looking for the stock to run up here to around the 36.5, maybe 37 area. Where are we trading at right now? 35.76. We're really looking for about a point move. Can we make money if the stock moves $1, 75 cents or $1? Well, we're about to find out. Okay. So in this case, we want to be looking at, by the way, these particular moves, they happen in around 3 to 4 week time frame. So I need to find some options that trade in the 3 to 4 week time frame. By the way, the December 17th options, they're perfect for this. 25 days to expiration. Got 26 different strike prices. Let's update this one more time. Come on down. Here we go. All right. If the stock's trading at $35.47 or somewhere around 35.5, and we believe it's going to go to, say, 36.5. Let's take the conservative view. 36.5. Well, a 36 call is trading for 45 cents. The break even's at 36.45. So for it to get 36.50, we're only going to make 5 cents on this trade if it happens on or around December 17th. That's not a good reward to risk ratio. But this is going to be a very, very conservative trade, guys. If we bought the 35 calls and we sold the 36 calls, and we did that, I'm going to show you 2 different trades. How much could we do that for? Less than $50. A 42 that can make a 58. Even if I could get that for $50, for 50 or 50 cents, that's a potential double with a small move. We just need 50 cents and the trade could double in value. What's the worst that could happen? It could go against you. What do you lose? 50 cents or $50 per option contract. You wanted a cheap trade? I saw one of you saying, I ain't got all this money. I got no fancy car and I don't live life like a millionaire, but I got nothing for love for you. Hey, I got nothing for love for you. And you know what else I got for you? A cheap trade. A cheap trade. You don't have to be a millionaire to take a $50 trade. Okay? You could do it twice. It's going to cost $100. And in fact, down the middle right now, it's showing $42. So that's a spread. Now, the other thing we could do is we could put on, let's look at a credit spread. Could a credit spread be better? Don't know. Let's find out. Back to our stock and option table. Okay? Here's KHC. Let me clear out what we did. And let's look at, again, we're going to look at the 35 puts to sell. Well, we could sell those for 79 cents. What if we bought the 34 for protection? So we're selling the 35, buying the 34. We're selling a put, but we're buying a lower strike put for protection. That's going to give us a limited risk trade. All right, here you go. This is only going to bring in $38. So that's the most you can make on the spread. What's the risk? $62. What makes this a better trade? Because right now it doesn't look like a better trade to me. I'm going to tell you what makes it look like a better trade. Kraft Heinz doesn't have to go anywhere. It doesn't have to go to 36.5. It can stay right where it is. It could go down to 35 and you can still keep that entire credit. But it's got to stay above that $35 strike between now and December 17th. All right, guys? What's the whole purpose of this? The whole purpose of this is to take advantage of the surge. Okay? Now, who in the room needs some more help with surges? How many of you want a little more help with surges? By the way, Jeff, you're looking at KHC and you're looking at the options. You're looking at the volume and the open interest. I don't want you to look at the volume and open interest. The volume and open interest are very sneaky for a lot of stocks. All right. The most important thing to look at is the spread, the difference between the bid and the offer. Now, we have to take this trade. If I'm going to take this trade, I'm going to take this trade knowing good and well that I'm going to stay into it all the way into expiration. And the reason why is because I don't want to take it off. I don't want to exit the trade. I want the trade to expire worthless if it's the puts. I want it to expire in the money if it's the call spread, and let the calls that I bought and the calls that I sold cancel each other out, and I just take the full profit. That's the way of getting out of the slippage on the exit. Okay, surge me, Tom. Okay, I just want to show you. I want to go back, and I want to talk about these 5 stocks: Tesla, BTBT, FTCH, Roblox, Roku. What do they all have in common? Well, I'm going to share that with you right now. All right, because we have a research project that we do over here at the desk called Operation Surge Strike. And Operation Surge Strike targets precisely this type of strategy. All right, so when I look at Tesla, All right. So let's bring Tesla up real quick. TSLA. When you look at this surge that happened, and the surge started, I mean, a lot of people say, "Oh, I wish I bought Tesla when it was at 850." No, you know what? That's a wish. That's a hope. That's a think. All right. But over here is a rules-based trade. This is looking at this back at the end of October. There's your surge strike. You did it here, you did it here, you did it here. You're fine. But what direction do you think the surge strike told you to go in for Tesla? Just say it, guys. Just chat it in. Was this a bullish opportunity or a bearish opportunity? Where do you think? I mean, we have the benefit of hindsight right now. So seeing that it went up pretty much speaks for itself. How about BTBT? Let's take a look at BTBT. All right. So BTBT had a surge that you got to go back here to the beginning of October. All right. And that surge really lasted from about October to about the middle of November, right around here. All right. So was the surge up or was the surge down? And again, hindsight. We all have the benefit of hindsight by looking at this. We see the surge was up, all right, but it didn't go down, but it went up. Tell me, if you were looking at this trade, what was the better choice? Buying a call option or selling a credit spread below the stock price? Buying a call option right around here or selling a spread down here, and you were going to make money so long as the stock didn't come back down. That's exactly what we did. How about FTCH? FTCH. Okay, so I want you to look at FTCH. You can see this trend has been down. Okay, but in this case, what was happening between the 3rd of November to around the 12th of November? Okay, because that was where your surge was. Okay, your surge happened before that, but do you see what happened here? I mean, you see the trend actually moved lower. Okay, but the thing is that if you're looking at this example, the trend was moving lower. So where was the surge? The surge pushed this lower. So how do you make money on something that goes down? Well, you buy puts or you sell call spreads. Call spreads are the ability to sell calls above the strike price, and then you buy something above that, and you're going to take that premium where if the stock goes sideways or it goes down, the premium drips into your account. Okay, pretty cool. RLBX. Where's the surge? Okay, let's try this again. RBLX. Where's the surge? do I even need to throw that one out there? Here's the surge. It happened right here. Look what ended up happening afterwards. All the way to the upside. You see that move to the upside? The surge pushed this higher. So that's Roblox. Roblox moved higher. The surge moved higher. So what did these 5 stocks have in common? All 5 of these stocks had a massive volume surge in them. And then for days afterwards, the stock carried itself into one direction because surge equals future momentum is what I'm trying to tell you. Okay? So a lot of you in the room just got an education. Okay? A lot of you in the room got an education. That is my education to you. What did it cost you? Cost you spending a little less than an hour in here with me. You got an education on this. For the month of November, our Operation Surge Strike. Well, let me just show it to you. All right. Here are the trades for Operation Surge Strike for the month of November. Let me put them in here for you so you can see. All right. And not all of them were winners, okay? These are all the trades that closed up for November. So here's a trade in Tesla, 83% return. Here's a trade in NET. That was a 12% loser. Here's a trade that was a break even. Uber was a break even. It entered and exited the exact same price. BT up 80%. All right. That was now, and these are holding periods. Like Tesla was only 5 days. All right. It only took us 4 days to figure out that NET was not working. That was a loser. 7 days, break even on Uber. 35 days. We had to stay in the BT trade for 35 days, but 80% return. All right. Take a look at FTCH. FTCH was a 9-day trade. Okay. Roblox, 88% trade. Roku, 90% trade. Lucid was the most recent trade that we pulled off, and it went against us. Okay. Operation Surge Strike. There you go. So those are the trades that we had in there for the month of November. Guys, again, it's a pattern that works far more often than it doesn't. Rolling in the tide, rolling out of the tide. Okay? Like Adele, we're rolling in the deep. Only we're not using deep in the money calls or deep in the money puts. We're using calls, puts, or out of the money spreads. Now, those of you that have Operation Surge Strike, thank you for being a member. I want to also mention that if you have a lifetime subscription to Operation Surge Strike, we have an app for that. We have some software for that. So if you want to scan like I do on a day-to-day basis for these kind of trades, give the folks a call or click on the button to learn more about how you can get the lifetime access to our software. It includes a year of our software as part of the lifetime program. So wanted to make sure you had that, for those of you that do get our Surge Strike, right? Surge Strikes, what's interesting about Surge Strikes? It's not so much price, it's volatility. It's a lot easier, and I've showed this, but it's a lot easier to track volatility than it is price. When we roll all of this together, guys, it all comes down to these three things. Doesn't matter whether it's Operation Surge Strike, money counter, cryptocurrency, or whatever it is, I'm doing these three things. Step one, spotting rules-based opportunities. For today, we talked about spotting rules-based opportunities in volume and volatility. Step two, create an acceptable high probability trade. And step three, plan, execute, manage. You know what that means? That means put the order in the way it's supposed to be put in. Put some limit orders in to get out when you hit a profit target that you want to hit. If that profit target hits, you don't even have to be in front of the computer. You get filled, you move on. If it doesn't hit and you come to the end of the pattern, whatever that pattern might be earnings, that pattern might be expiration date, then you simply cancel your limit order and you place the order to exit, win, lose, or draw. Okay? That's it. That's all the time I have for you today, guys. Thank you for joining me. Those of you that are right here hanging out with me at Monday Morning Live, I'm going to be back here again. YouTubers, same thing. Going to be back here again at 9:30. And tomorrow, I'm going to get into high probability trading. So we're going to continue with some high probability trading. Till then, thank you all very much. Love you. I'm out of here. We'll see you tomorrow. Bye, everyone.